Welcome to Retirementals, a podcast that dives headfirst into the issues facing the financial sector at the intersection of investment, technology, and financial advice. Hosted by Abraham Okusanya, you can expect raw honesty, critical analysis, and energetic interviews. Here is your host, Abraham Okusanya.
All right, hello and welcome to Retirementals. I'm Abraham Okusanya and I'm so delighted to have you all here on the podcast today. Now, just before we dive right into the podcast today, we've got a fantastic session, an episode planned for you. Can I just say, if you're listening to the podcast, do me a huge favor. Leave us a review on is it called iTunes now or Apple Podcast? I don't even know anymore. Or wherever, whatever platform you listen, to the podcast on. Leave us a review on Apple Podcast. Let us know how we're doing, good or bad. By the way, give us a review. I am really excited about my guest today. It's someone that I have looked up to for many years since I stepped into this industry, and dare I say, he is, I consider him a friend, an inspiration, to me personally in my journey. He was one of the very few platform CEO who gave me a time of day when I came on the scene a few years ago. I'm talking about none other than the legendary David Ferguson. David, welcome to Retirementals.
Well, welcome. As an extraordinarily kind introduction. Thank you very much. We'll see how people feel about that later on in an hour's time.
No, I really mean that, David. It must be sort of probably about 10 years ago, when I sort of set up my firm for Finalytic at the time. Yeah. And you were clearly one of the very few CEOs on Twitter, and you were probably the only one who listened to what I had to say. But look, just for the purpose of people who maybe have been living under the rock for the last 15 years or so, give us a bit of a background to the journey that led to the creation and the rise of Nucleus.
Sure, okay. So I guess the roots of the company probably lie somewhat in my personal background and also in the background of Philip, who started the business with me. Yeah. We were both failed actuaries, I guess, is the truth of the matter. And we worked for a couple of life companies and asset managers early in our career. And I was also a bit of a technology geek. And it just struck me really early on, actually, when we were in our mid-20s, that the industry was set up really badly against the customer and also quite badly, actually, against advisors as well. And it's obviously long before the RDR and like that. And we thought it'd be so much better if instead of getting paid commission by providers to sell their stuff, if advisors were paid by the clients to put advisors on the same side of the table as clients, basically. And if we could create this kind of technology and operational infrastructure to encourage that and catalyze that, that would be a really good thing to do. And we started thinking about that back in the late 90s, in about 1998, I think. And a long story short, we ended up, it took us 8 years, I guess, to get started, but we got started in 2006, and kind of here we are 15 years, almost 15 years up, a couple of months time, maybe 15 years later. Yeah. So and it really what it was about was saying the advisor is the most trusted and important relationship with the client in this whole chain. It wasn't, nobody really cared that much about the products. It was much more about the kind of trust and reassurance and that sort of stuff that the advisor could provide with the client with. And I think that's remained true really throughout, to be honest, Abraham. I'm really pleased we've never really deviated from that principle. And, things have come and gone and trends have come and gone somewhat in that time. But ultimately, is that how can we make, what can we do to make the advisor more effective for the customer. That was kind of what it was all about, and remains very much true today.
Incredible. I'm interested in some of the early stories, right? So if I remember this correctly, I might be wrong on this. So you and Philip were running your consultancy, marketing consultancy called Abacus at the time, and you obviously were consulting for live companies. Maybe AXA, I remember around the time, again, correct me because this might not be true. And then you decided that you're going to set up a platform. A, I'm interested in the inspiration. B, I'm interested in how you got funding for this. Was it just a case of sort of knocking the door of, I don't believe that you had VC funding at the time, so was it a case of knocking the door of IFAs to see who will give you money, or how did you go about raising money for that?
So the sequencing, that's broadly right, but the sequencing is slightly different in that we made a decision to try and start a platform business before the Abacus started. And the Abacus was actually essentially a lifestyle business that allowed us to kind of eat and stuff like that, while we were raising the money for what ended up being Nucleus. Now, we didn't know at the time it was going to take quite so long. So I think, I can't remember actually, but I suspect when Philip and I went into the Abacus, we thought it was probably for a year or 2 or 3 years while we got the funding together. And as it turned out, it was for 7 or 8 years, and we had a lot of fun doing that actually. And as you say, we did sort of strategy, product design, and marketing consultancy for most of the insurance companies in the UK and many of the asset managers. And we actually did some of the work that kicked off the profit review for the FSA at the time, which is great fun actually. So yeah, that was how the sequencing was, I suppose. On the how we raised the money, we were the only person we really knew who had any avenue toward funding or to introduce us to people was a guy called Peter LeBeau, who was I think he was the marketing director at Swiss Re. He's actually a lovely man who people listening to this might know. Absolutely wonderful individual, a very well-connected individual. And he introduced us to a guy called Paul Bradshaw, who again will be known to many people and sadly died a few years back now. But he ended up becoming the founding chairman of Nucleus. But he was the guy who really opened the doors and helped us guide us towards what ended up being the funding we ended up with. And we looked at lots of different business models, actually. There were lots of versions of it. I always loved the spell. There was a wonderful time back in 2002, I think it was. Paul was sort of hanging out in an office on Bishopsgate in London, which is the office of Hawk Point. Lots of people came and went, actually, and lots of people who've done really interesting things in the industry hung about in there. And in a slightly romantic take on it, I always thought it was a bit like the Beat Poets, the financial services equivalent of that. And a load of interesting folk came and went because Paul was an amazing connector and huge brain, and I just knew how this is all going to play out. And a lot of people would have turned to Paul to be their guide or mentor or access to, provide access or introductions to funding. And so it came, and we worked on that for a number of years, never quite landing the right model. And then we almost got backed by AIG actually in 2004 or 5, and they walked away quite late in the deal. And Paul actually at that time was introduced. He got the job. He gone back to an executive job actually with Santander, or Abbey as it was at the time, I think. And I kind of stepped up into the sort of CEO box, I suppose, at the time of this not yet started business. And he introduced me to a guy called Angus Samuels, who at the time was looking after Sanlam's UK interests, and actually is now Nucleus chairman. And he really liked the idea, and essentially we put together that version of the business plan, which was this, essentially a business that gave advisors a probably unprecedented influence over a platform. Sanlam had a minority of the equity at that time, and management were there to try and build the thing, So we got started. I met Angus in April 2005, and we got started in June 2006. Yeah.
Wow. Incredible. Sorry again for my intrusion. Do you remember what the valuation was right out of the gate? And
well, it was funny.
It
was essentially valued at nothing because we were going to set up a regulated business. We had to have regulatory capital and stuff from the beginning. And so we raised about 4.5 million. If I remember correctly, it was $1 million of equity and some preference shares. But it's about 4.5 million. We had a subsequent round in 2010. I think the thing that I'll probably remain proud of was that the total accumulated losses of Nucleus were 10.2 million. So we only ever burnt 10.2 million of capital. You know, I thought that was always quite a good thing. And yeah, so that was the kind of whole. So and most of that money was, you know, I suppose the deal kind of was that Sanlam put up most of the money, the IFAs brought the clients and the assets. And I think it's really important to remember as well at that time, we kind of redefined the pricing in the sector somewhat. You know, we came in at a price point which was probably, I think we were, you know, 40% cheaper than Transact at the time or something like that. Yeah, and all the fund supermarkets were getting paid kickbacks by everybody left, right, and centre. So, you know, we came in with something which was materially cheaper, if you like, than the rest of the market. And I remember listening to lots of people, you know, complaining about IFAs having shares and all. You still see it to this day sometimes, incredibly. But you know, there's this whole thing about conflict of interest, and nobody ever argued whether there was a conflict of interest or not. It was whether it could be managed or not.
Right.
And we were very relaxed about that. And even when you talk about vertically integrated businesses today, which I guess we may come on to in this discussion, yeah, Nucleus was vertically integrated because the IFAs owned more than half of it. And, you know, the fact that it had been done for the customers good seemed to be escaped most of the people who were arguing about it. Yeah, we thought it was a kind of interesting at the time, a sort of crowdfunding thing, I suppose, almost, although that language possibly wasn't used in those days. So yeah, that was how we got started, I think, yeah, as I recall.
So you pioneered essentially this idea of sort of IFA ownership of the platform.
Well, I think if I remember correctly, there were some IFAs who had shares in Transact from the beginning or near the beginning, and I think that was also replicated in Eccentric. But I think we were the first one that sort of gave them a proper seat at the table, you know, and had it as a part of our governance structure rather than just, you know, most other people that did it had sort of free shares they gave away. And what's often overlooked actually in Nucleus is the IFAs didn't buy the shares at a discount to the price anyone else bought them for.
Right, they paid full price.
Real money, it was proper cash. And they didn't get any preferential terms at all. And that's often been lost to the mists of time.
Okay, cool stuff. So no. I just think that it's easy to look at Nucleus today, you know, a very successful company, and to forget what those early days was like. So I wanted to go back into it. But let's it's worth really quickly saying, and I always say this because quite a number of the people that were the first 20 people into Nucleus or whatever are still with us, and it's also fair to say that it was obviously utterly hellish at times as well. You know? we all got sort of fond memories of some of it, but it was also, some pretty shocking times in there as well. But there you go. It's natural to start up, I think. Incredible stuff. So now let's move on, you know, to the elephant in the room, so to speak. So you which is the sale of Nucleus to James A. You were in the room where this all happened. And I'm fascinated about how the story went down. So was it just a case of Richard Rowley, who runs, James A, called you up and said, David, I'm going to buy you. And then you say, go flip yourself. And then he goes, no, seriously, I want to buy you. And then you said, back and forth, right? And then you said, well, if you're really serious about it, I've got to put it to my shareholders. How did this go? How did this happen? Tell us.
Yeah, so it was nothing like that. First of all, I guess what happened is I mentioned Sanlam earlier actually as the founding shareholder in Nucleus, and and a really great shareholder for the business as well. Actually, the company simply wouldn't exist if it wasn't for them. And we went through a spell particularly in late 2008, I always remember, where the world had kind of gone bust, and Sanlam invested another £2 or £3 million in us at that time to allow us to continue. So in essence, what happened, Nucleus has been a listed company for the last 3 years almost. It has a majority shareholder, despite being a listed company, if you like, which was Sanlam, who have had 52% roughly of the business since then. They made the decision to exit that at a point. I don't know when that was. That's their decision, and I'd imagine in the last 12 months or sometime like that. And in disposing of 52%, they decided to sell it to a single party rather than sell it into the market, which was their right. And that led them to, I guess, trigger a process to seek a buyer for that stake. And then, as was reported in the media late part of last year, there were two bidders came forward initially, and then others entered the process for a little while. And so I only met Richard, in the due diligence phase in December or something like that. So the process was initiated by Sanlam, and then essentially came to our board. And the way it works is, as a public company, certainly you become basically bound by the takeover panel at that point. And the process goes from being something initiated by a shareholder to something which is then, if you're owned by the board, if you like, And there's a whole long story about the complexities of that, which is, I would imagine, not terribly interesting for anyone on this call, on this podcast rather. But ultimately we got to a point where in January, Epirus / James Hay were the remaining bidder, and obviously we now been working with them for the last 3.5 months. So 3 months, something like that, to work through the next steps. But it's also very interesting and worth saying that as a process, which is a private takeover of a publicly traded firm, there's actually quite a lot of very strict rules governing what can and can't be discussed between the parties at this stage until the deal completes. So the expression we started using back probably in December, actually, I think it was, when this was all kicking off, was to get comfortable being uncomfortable, because there just is a lot of uncertainty around the place, and whether that's for our staff and people that work at Nucleus, whether it's for advisors use Nucleus, whether it's for suppliers, whether it's for myself, it's just the way it is, and we're still in that period right now. So it makes it, for some people, I've found that really difficult, because some people like to have more definition in their lives, if you like, and I can completely understand that. And equally, some people are happy to sort of roll the dice every day in the way they live their life, and take each day as it comes. So we are in this kind of interesting but uncertain time just now, which is, I think everybody, frankly, all parties would rather that wasn't the case, but it's that thing, when you have to live by the law, it tends to matter to people, which is the way it should be, So that's where we are. Yeah.
No, it's incredible. It's, certainly, an emotionally challenging time, or challenging more than emotionally for many people. And it's a sensitive conversation, right? So the thing I'm trying to get my tiny little head around is the public valuation of Nucleus, right? And why there is this perception, that why Nucleus, for instance, is worth, less than, maybe about around 1/10 of what the likes of AJ Bell or AJ Bell or Transact might have. They might have 3 times your asset, but in terms of the actual valuation, it's 10 times that. And I'm thinking, from your point of view, what's the driver behind this? And my I guess my worry or lines of question is actually, if when I think about what you've accomplished with Nucleus, essentially, let's just say, I know that's not how it happened, but you bond, 10 million cash bond, the company listed publicly, now trade, or the offers around 145 million. So that's like 14 times the investment. Sanlam would have invested, let's say, I don't know, but let's say 5 million of the half of that amount. And now they're getting 14 times the value of their investment, something like that. And yet there is this kind of perception that, maybe Nucleus hasn't lived to its valuation from a investor's point of view, expectation. And I'm thinking, where is this coming from? Is it just that the likes of AJ Bell and Transact, and indeed Hargreaves Lansdown, right, all of them worth over $1 billion in valuation, they've just set this outlying or outlier expectation for the market around platform?
No, I think there's a few things people look at. I mean, in the end, the valuation is driven by, it's obviously multiple profit in the end, right? That's the key thing, right? And those numbers themselves, the profit will tend to be a function of scale, because the way these businesses work is that there's substantial operating leverage emerges in them, operating margin emerges quite quickly once you get past a certain point of scale. And Nucleus is probably, at that point or near to that point now, where we felt the outlook, and particularly when we bought the Genpact business in December, we were very happy that was set to improve the financial scalability of the business, if you like. Then when you come to the scale piece, it's really, obviously that's a function of flows effectively. And we definitely went through a spell where our flows were not keeping up with the market in terms of what were being achieved by the businesses you mentioned. And I think we got, the market, chose to penalize us for that in the way they looked at the stock. And I guess that in some respects led us to today's situation. So I think, if you look at the multiple that Transact is on, say Integrafin's on, versus the multiple Nucleus is on, I think it's maybe only twice as much or something like that.
Right.
But
in terms of margin, sorry.
No.
Right.
So it's like if we're valued now on, I should know the numbers off the top of my head, but if we're valued on 20 times earnings or something like that, they're valued at 40 times or whatever.
Right.
They've also got their earnings are much greater because they're further down the road. And what's quite interesting is that Nucleus is actually bigger in terms of assets at the same duration since inception than Integrafin was. So this is a 7-year older business than we are, obviously. And AJ Bell is many years older than us. And but for whatever reason, I think if you went back to if you go back to 7 years ago, I suspect Integrafin was probably worth 150 million or something. I don't know, but it was obviously privately owned. But I'd be surprised if it wasn't priced similar. I think where Integrafin and AJ Bell are is they've got past the proof point of we can deliver scale. And actually, we can deliver scale without doing what life companies do and incur another £100 million of cost. So it's whereas Nucleus has got that promise, but hasn't been able to demonstrate that yet. And I think that's probably the main reason why there's that differential. And I think that's. I suspect if you looked at the asset management industry, other comparable sectors, you see the same sort of dynamics.
So it's interesting. Leads me to the next question, which is: do you think that you went public too early?
I think it's an interesting question. I mean, we had an obligation to consider that exit as part of our shareholder agreement, so we didn't actually have a huge amount of choice. We actually went at the later end, if I remember correctly, of the date range that was in our shareholder agreement, and we had an obligation to explore an exit at that point because a lot of people had backed us for 12 years at that point, capital tied up in the business and all that sort of thing. So I think we, if I live back 2018 and 19, we got a bit lucky. We listed right at the top of the market. I can't remember, I think it was the Brexit concerns or something bit in the midpoint of 2018. And that led to flows slipping back. And everyone says when you list a business, the only thing to really make sure you do is hit your numbers. And bluntly, we didn't. And you get penalized for that. And it takes you a good year or two, I think, to rebuild that confidence from investors. And as it's turned out, we didn't have the luxury of time on that. I think it's as simple as that. And as you know from the public data we released recently, we just had our best ever quarter. But and obviously we're in a bid situation now, so you don't know how that's going to be reflected in the price. But I suspect if we'd had 6 quarters like that or 4 quarters like that, then maybe the world would have been different. But equally, we now get the opportunity to try and achieve that scale and that operating leverage and that valuation in a different structure with the James Hay group, or James Holdings, sorry, and hopefully see through the journey in a non-organic way that we set out to try and do 3 years ago or 15 years ago, depending on where you date it from.
Now a word from our sponsor. Nikki Heaton-Jones is the Managing Director and the Chief Investment Officer at Betafolio, the high-tech, low-cost, discretionary model portfolio manager. Nikki, there aren't many flat-fee, retainer-based model portfolio services out there. Why is Betafolio pioneering this approach?
I think we're more than a flat fee model portfolio service. We're a true investment partner. We're offering a full investment service to advisors and taking it to a deeper level. We don't just want to push a button and send an investment template. We're building technology and processes so that we can support advisors at the individual client level with client portfolios on real practical issues like cash management and decumulation and lots of other areas that are associated with actually implementing a financial plan rather than just providing a model portfolio. So that's where I see us as being pioneering and perhaps taking the MPS products to a new level.
Thank you very much, Nikki. I just like your honesty and candor about this, David. Obviously, it's a challenging time for many members of your team, and there is, not an insignificant voice within Nucleus who maybe aren't comfortable with the deal, and they've said publicly, but the deal's now been turned into, effectively a takeover bid. What does that mean? Does that mean, what does that mean?
Yeah, it's just a different mechanism. So the original method, sorry, I'm not an expert in this at all, but I think there are 2 ways you can basically effect a takeover in this type of business. One is what's called a scheme of arrangement, and that was the method that was being pursued until a few weeks ago. And then James Hay switched to a takeover offer, and I think ostensibly they're just different mechanisms to achieve the same thing. Ultimately, they've got slightly different thresholds for success, if you like, and the way the process runs. But ultimately, they both have the same end goal, if you like. And we're now in an offer period, or still the whole thing is called an offer period, so the language is very complex. And we're now in a process where the takeover offer was launched, I think, was it last Tuesday or something like that. And there's a whole bunch of dates that are relevant in that whole process, which shareholders have been invited to take up that offer, and that's where we are. And I would expect that to proceed as frankly the scheme of arrangement might have proceeded. And you made a point about some people in Nucleus being in opposition to this, I think that's evidentially true. And I don't think, I think in probably any M&A situation, there's people who have concerns, or I mean, the very structure that exists, frankly, of that sort of representative body is in the takeover panel rules, so it's there as a sort of statutory instrument, if you like, to allow people to have their say. And that's, I think it's right that people do have their say. I mean, why wouldn't you have that? You'd want that. And Nucleus has had a way of being for 15 years where people are encouraged to speak up and join in and have, try and make things in the business improve or whatever. So, that's frankly, if people really care about the business, I think that's ultimately a positive thing.
So you've had your best quarter yet. You've had your best quarter so far in Q1 of 2001. I'm keen on your thoughts on what do you think is driving this, and B, are you kind of seeing this as some sort of endorsement of the new direction from IFAs?
Possibly. I think we'd begun to build really nice momentum back end of 2019 into 2020, right? So Q1 was going very well for us last year before the pandemic bit, obviously, and everything kind of slowed down. We then had like everybody, a pretty rough, say 6 months probably through the spring and summer last year. And then things picked up really strongly from really September, October, November, December, right through Q1. So I think what we've seen is a continuation of a positive trend that started for us in Q4 2019. And I'd say that was probably something that reversed the negative period of flows we had just post-listing, where we probably had, I don't know, 3 or 4 quarters where we kind of disappointed a bit. That meant that, had it not been for the pandemic, I suspect that momentum that was building in Q1 last year would have continued through last year. So I think it's more we've been getting things right on the product, on service, and on pricing rather than anything else. I think everyone's had a pretty good Q1 because there's been quite a lot of capital accumulating in people's bank accounts, to be honest, which is money that some people haven't been spending through the last 12 months. But yeah, certainly it was nice to get a really strong quarter in Q1. And, like all things in life, it's nice to have your best ever anything, really, isn't it? Whenever and however it occurs. So that was really cool, actually. Yeah.
So let's move on to sort of a more wider industry trend. Clearly we've seen sort of, let's call it a flood of private equity money into the platform space. There's the EPRIs. I'm not actually sure how to pronounce them. Is it EPRI?
I think it's Epirus.
Epirus, all right, Epirus, and ANACAP, and a few others in the sector. I wonder what your thoughts on this are. Is this good or bad? And more importantly, from an IFA's point of view, is this a more reliable sort of long-term ownership compared to, say, the traditional, live co or even public market?
I think it sort of remains to be seen. I don't think it's as easy as saying one model is right or wrong or better or worse. I think what's really good is that certainly in this space, and certainly in beginning to get to know the Epirus people and the James Hay people, there's a really clear understanding, and this is kind of what you see with Integrafen as well and AJ Bell. Nobody is likely to be very successful in this space if they run a low quality product or low quality service, right? I don't think there's an opportunity to make a lot of money doing a bad thing. I don't think that exists, right? You've seen people, there's been lots of money plowed into the platform sector over the last 10 or 15 years that's done really crap work and delivered really poor products, and shareholders have lost out, So I think if, whether it's private equity or public markets, whatever, if it's well understood that to be successful in this space, you've got to be pretty good at what you do and have good service and all that, I think that's a great thing, and is a really positive change from maybe some of the lazier capital that's been in the sector in previous years, which may have come from product providers or wherever, where they they didn't really know what they were into, they didn't understand the technology, all that sort of stuff. So if private equity helps sharpen up the sort of quality of management, the quality of products we see in the market, the quality technology, implementations, all that sort of stuff, then frankly, I think that's a really, really positive thing. I think it's more, I think, and again, similarly, frankly, in public markets, you've got a business like Integrafin and AJ Bell, which are, great businesses in their own way, being successful in the public market. So I don't think you can draw an obvious conclusion about what's the best capitals or best type of capital to run a platform business. But I think you can probably say the worst capital is probably soft capital. It doesn't really know what it's doing. And we've seen quite a lot of that in the previous decade or so. And so rather than be a cheerleader for public markets or for private equity, I'd probably look at the other way and say that the more dangerous road is where the capital doesn't really know what it's doing and it doesn't have anyone to hold to account effectively on it. And I think that's where we've been, to be honest. And I don't think we're in that space now. There seems to be, there's maybe some of it still around, but most people now, I think, would accept that you've got to be delivering something pretty good to be successful here. And that's a good thing, right? I mean, a lot of financial services companies, and some still today, get away with making a lot of money not being very good. We'll maybe go into regional asset management later, but there's a sort of, in most industries, successful companies do something good for some customers, right? That's pretty well trailed path in most industries, and unfortunately hasn't always been true here. So yeah, I'm sort of rambling now, sorry, but I don't think that the type of capital is the single most important driver of success.
So I like what you say about the way I'm interpreting it. It's about this intentional capital versus kind of, did you call it lazy capital? I forgot the time that you.
Yeah.
Right. So we're seeing this trend towards, sort of vertical integrated model, but coming from the asset manager side of things. So you see the likes of Schroders, M&G, and indeed, Vanguard, wanting to own more and more of the value chain. So they, all of those in these examples are asset managers that have created a platform or bought a platform and then, bought or building, they're now buying or building out their advice channel. What's your thoughts on this?
Yeah, but I think the theory is entirely sound, right? It should be possible to use the economies of scale and the integration of those business units to deliver something better. I mentioned earlier, I think that Nucleus was effectively a partially vertically integrated model right from the very beginning. And we managed to cut the cost to customers by having advisors as shareholders. And what we've just done with our model portfolio service, again, using the insights we've got, we've been able to launch something which is lower cost than not in every model portfolio service in the market. I appreciate that, but more than many. And I think what I find really distasteful is these models where we integrate the whole thing solely to keep selling junk to people that nobody else wants to buy. And that's what I get really uncomfortable with. And it feels to me that the overall price, the chain. I always think if you look at the presentations that some of these firms give to analysts, and then look at the brochure they put in front of their customers, they're entirely different things, right? And I have a real problem with that. I think if you believe in what you're doing, tell the truth, but if you've got a total cost in the whole chain of 200, 250, 300 basis points, my sense is there are very, very few retail customers that need to be paying that much money, right, for this stuff. And I think for as long as people are paying that, there should be question marks over those business models, and I find them distasteful, because I don't think it can possibly be consistent with good value for money.
It's interesting. One of the sort of blessings, I say, of my career is that whilst other people were reading brochures, the consumer brochures of platforms and providers, I was reading their financial statement and analysis, and you always find it incredible sort of I'll go as far as saying conflict, maybe coherence in some cases between what they're telling consumers and indeed what they're saying to shareholders and investors. And I've always found that, fascinating. Another trend that we're seeing in the platform sector, perhaps, at a much earlier stage of, this idea that mid-sized firms can run their own platform in some shape or form, so they can buy the technology, maybe get the regulatory permission or some regulatory permission, and have control over, a degree of control over the cost and the level of service to consumers or to their clients. What's your take on this?
Yeah, I think it's very interesting. It's actually kind of where Nucleus started. 7 firms. I should have mentioned at the top of this. I mean, we got approached by firms. Some of the first firms that joined Nucleus, and people that approached us to build a platform for them. It wasn't like we went out and found them all. And I think it's a very interesting development. I think the only challenge I've got is, I think if you're kind of clipping the ticket, as it were, I think you've got to be doing something for that. I don't think it works if you're just passing something through and taking 10 basis points out of it. I find that pretty tricky. But I think if you've got an advice firm, and then whether people are using, Pershing or Seckle or Hubwise or whatever, all these models can work. I'm not sure that every advisor firm that is doing it fully understands what the consequences might be for their regulatory capital, for their regulatory responsibilities. What happens, how seriously are they dealing with their requirements around material outsourcers, all that sort of stuff. What are they going to do if one of these businesses withdraws from the market or goes bust or whatever? Have they really got the oversight of what's going on every day on client money and all that sort of stuff? So I think it's, if I don't know, pick a random name. If Brewin Dolphin can run their own platform, I don't see why a much smaller financial planning business can't do it. In terms of from a legitimacy point of view. But I think, just as I'm sure Brewin Dolphin take it very seriously from a regulatory and oversight and whoever they use for their tech and everything, I'd expect an advisor firm to do likewise. And I think that's where I don't think there's a huge body of evidence yet to demonstrate that's being done, and it may well be being done, but I don't think it's not obvious yet that this has been a success, because it's a reasonably new approach for most people, and we probably won't know for another few years perhaps whether this is going to work. Because if you get a scenario where this works just now because you think you can charge 35 basis points for a platform, and let's say the platform market price is at 20 basis points, well, is it okay if you just still also take 15 basis points out of this still, or do you have to now make it 20 bips and then you can't afford to do it anymore? And there's a whole how does that, how durable is it, remains to be seen, I think. And there's a long history of IFA firms developing software, tools, stuff like that. And in most instances, they've kind of hit a point where it doesn't scale, or they can't maintain it, or the cost of maintenance goes through the roof, and all that kind of stuff, right? And equally, I think if you're a financial planner and a successful financial planner, that's kind of what you are, right? If you want to be a platform as well, that's legitimate, but you've got to have the expertise to be a platform as well, because it's it just isn't. I mean, people. You hear people say platform's just technology, and one level that's true, right? At another level, it's just not, because there's thousands of operational processes going on that you've got to understand underneath the bonnet. And similarly, I remember speaking with John Baxter years and years ago.
Yeah.
When I think he built some great stuff with I think Giles Pidcock, I think back in the day, to do sort of cash flow modeling basically on spreadsheets, which was really at the time was amazing, you know. But ultimately, I guess maybe they still do it that way. I don't know, but it's these things have tended to become productized. You know, proper software teams working on them now, and I'm always just slightly wary what people's motivations are to get into this stuff. And if it's to deliver something much better and more efficient, then great. I think in instances it's just to make a bit more money without taking any more responsibility, and that's a bit less comfortable for me.
And I think this is fascinating because I almost feel conflicted about this, right? You know, on the one hand, I understand you know, the dissatisfaction that advisors might, you know, find with platforms, right? With the sort of mainstream platforms that they use, you know, and I understand as once a small business owner that, you know, that kind of natural tendency to want to just, you know, break down the door and do it yourself, right? On the other, I think we have to face the reality that advisors are not tech companies. And, you know, added to that, all the regulatory sort of, you know, things that you just had added to this. And I don't know is the honest answer where this is all going to lead. I mean, and then you look at, you know, some of the platforms that have been trying to do this for years haven't sort of scaled in a meaningful way. You know, so no, I think it'd be interesting to see, you know, to see.
I think that's right. It's a really interesting thing because it's, you know, you get this thing where it's quite appealing to want to have more control. I totally get that, right?
Yes.
But, you know, like I know in our own business, you know, if we add a new transaction type onto Nucleus, right, for some tax wrapper or some, you know, the consequences of that can be quite profound, right? Because it runs right through the client reporting and right through the entire registry. It runs to our CAS resolution pack. It runs right through, you know, everything we do, you know, and the idea that you can just sort of just do that in an afternoon is just nuts, to be honest. It's just nuts and it's irresponsible. And anyone that says that doing that is easy is bluntly full of shit. You know, it's not true, you know, and I don't buy it. And there's a tendency to think, oh, it's just that or it's just that. These things are operationally very complex businesses, whether people like to believe that or not. And, you know, there's a guy that runs our client money stuff, for example, at Nucleus, Scott McDonald. And if you want to come and spend a day in his life, no, he's a great guy. He's a very smart guy and he's top quality individual. But if you want to know, you know, he sits in, him or someone in his team sits in all our change programs and roadmap stuff, because there might be a kind of CAS consequence. And you have the same issue on cybersecurity or on, you know, any other lens you want to put on it. But some notion that 5 people can get together and do this at scale is just, I think it's crazy and dangerous, actually. Because I remember listening to Angus MacDonald, I think is the Hubwise guy, isn't he? And he said at one point they'll never employ more than 10 people or something. And it's like, well, I think it's already untrue, but you know, it just doesn't work like that, you know. And you know yourself, building your own business, that I've always believed there's a substantially different challenge in building a product than there is to building a business.
Yes.
Substantially different, right? And so it might work when the first 10 of you get together and build it. And what happens if 3 of them leave, right? What happens then? And then the other guy, and then you have, you know, people's lives change and they want to change their working patterns or whatever it is, you know. And to create something that actually works every day and doesn't fall over when the first guy, you know, decides for a change of career or whatever, is not the same as knocking something together in a, you know, in 3 months or whatever. So I sort of, I'm a great enthusiast actually for that advisor influence and control over how these things should be. And we built Nucleus entirely like that, and all the roadmap stuff gets massively informed and influenced by that. But equally, sometimes we have to say, like, some of our budget is going on this now because we need to invest in the, you know, the scalability of this bit, or the, you know, whatever, security, whatever it is.
Look, this is a podcast about retirement, right? So I think you know, tell us, you know, what does David Ferguson retirement plan and portfolio look like? Give us an insight.
Yeah. Okay. So as it happens, this will date this, but this is our son's 6th birthday today, as it happens.
Congrats! Happy birthday to him.
So my personal plan is to be doing something meaningful and full time until he leaves school, which is, I guess, 12 and a half years away or something. By which time, should I be spared, I will be 63 years old. And I'm not sure I really believe in the concept of retirement entirely, to be honest. I appreciate it's the name of your podcast, but I don't think, I don't like the idea of stopping doing this stuff entirely. I don't think that's my thing. I don't have any particularly major hobbies or things I want to do outside of this. So I would think if I get past the next 12 years doing this sort of thing, and maybe I'll spend the however many years I have after that doing other interesting stuff with interesting people.
No doubt. And you know, you obviously have a very large seed pot. Tell me what. A very large pension pot, I'm saying. But tell me what's in it. Sort of funds, asset class wise, what do you invest in?
So our, I'm not terribly active in this stuff at all, actually. So our assets tend to be sitting in index funds, Nucleus shares, or defined benefit pension schemes from my earlier days. That's probably it. It's not very complicated or exciting, I'm afraid. And
yeah, I find it fascinating, right? You know, I mean, you know, people in asset management or investment industry generally tend to have incredibly, maybe the ones I meet tend to have incredibly simple sort of, you know, portfolio, which is interesting.
I think you know yourself in your own business, you end up being overexposed to your own single stock, right? And I think that makes quite a strong argument to do something pretty vanilla with the rest of it. That's how I look at it anyway, in a simplistic way, you know. Yeah. And obviously, if I had lots of money kicking about, I'd obviously invest it in Nucleus IMEX as our new, which is a very wise solution for anyone looking for something that's better value and a bit more personal.
Yeah, no, it's incredible. I really want to talk about IMX and how you are, you know, sort of changing the landscape on that. So you have 1 minute. Go on.
Yeah, basically, we took all the lessons in that from the institutional market. And, you know, we've always thought retail asset management's kind of oversupplied, overpriced, and underdelivers. And, you know, why don't we bring the lessons from the institutional market into retail, where basically you've got more informed buyers is the biggest single difference in the market, right? So we figured we could take a load of cost out and deliver something more personal by focusing on the outcomes people are trying to generate rather than on just trying to, you know, match a volatility band or something. Yeah. So we've been working on it for 2 or 3 years, maybe a little bit longer. It went live properly on 1st of January. We're getting some nice traction now. Yeah. So I think it's a really valid addition to the market. Actually, I think it's sufficiently different to a whole bunch of Me Too solutions. And I think it's got a really good place in the market. Actually, I'm excited about it. I think that whole joining up of technology, you know, outcomes, portfolios, monitoring, how the tech, you know, keeps you on the with the right probability of success, I think is a pretty big part of financial planning going forward. So if IMX is a stepping stone towards that, then we're pretty proud of that. Yeah.
Good stuff. Incredible stuff. Final question, a little bit unfair, right? You know, but, you know, what's next, for you? You've been a pioneer and inspiration in the sector. What's next for David Ferguson?
What is next for me? Right. So next is I'm going to go and make a burger and chips. Son's birthday, and I'm going to pick up my mum. Who's going to come around and give him a birthday present. And then I'm going to get back to, as best we can within the confines of our current construct, working with Richard and the guys at JMC on how we're going to make this thing into the best platform in the UK. So that's kind of that's on my agenda. Not all this afternoon, I'm happy to say. We'll probably run out of time, but that's what we're trying to do.
Incredible stuff, David Ferguson. Thank you for your time today. Thank you for the incredible work that you've done in the industry and that you continue to do. I am personally grateful to you. As I said, you've been an inspiration, and I look forward to what's to come. So, David Ferguson, thank you very much.
Thank you very much. It's great to spend some time with you, Abraham. Great stuff. Keep up the good work.
I'll be remiss if I don't thank my incredible team who worked very hard to put this program together, led by my producer, Hannah Dickinson. Thank you very much, guys. I'd like to thank our sponsors, Timeline App, the retirement planning software, and Batefolio, the high-tech, low-cost flat fee model portfolio manager. And to you, our listeners, thank you for your time. I hope you've had as much fun listening to the program as we have making it. You can find more about the show at retirementals.co.uk, and you can follow me on Twitter. My handle is Abraham on Money. Until next time, thank you and goodbye.